Welcome to all the participants who are attending this program. For introductions, my name is Sanjeev Dandona. I am a chartered accountant. I've been into the practice of accountancy and also been holding positions in corporates, and I carry a 35 years of experience with me. I'm with in academics for the last 5 years, and today I have an opportunity of conducting a program on Introduction to Goods and Service Tax. Let's see what this Goods and Service Tax is all about. We always had a system of taxation, and under the system of taxation, the government of India was empowered, the power given by the Constitution of India to levy taxes, various kind of taxes, on the citizens, institutions, bodies, and corporates to collect money by way of these taxes, which could be used by the government for various functions, administrative, developmental, and other services, which is the obligation of the government to provide to the citizens. We also know that in the last year, there was a major revolution in the taxation system, and that revolution was brought in by the replacement of certain taxes by a particular tax called Goods and Service Tax, which in the abbreviated form we refer it to as GST. First of all, what we need to understand is that what was the necessity for the government to introduce this tax called GST, and most of what you remember that the government was struggling for about 4 to 5 years just to bring in GST. There was a lot of opposition from the state governments, from various parties and stakeholders, but finally the government succeeded. Where was the necessity to bring in GST? When we already had a taxation system, we had various taxes both at the central government level and at the state government level, and the taxes were being collected by the government. So where was the necessity to do all this? Obviously, when the new system was introduced, it meant scrapping of the old system. There would have been a heavy amount of expenditure that was incurred by the government to bring this new system in place. What was the old system and what were the problems? Let's try to understand that. As you can see in my PPTs, under the existing system, there were a number of taxes being levied on the very same transaction, either by the government, state government, or local authority. What I said earlier, that there were a lot of taxes which were being charged by the government. That exactly was the problem. We had taxes being charged at the central government level, we had taxes being charged at the state government level, we had taxes being charged by the local authority. When I say local authority, it basically means the municipal corporation, the gram panchayats and all that. And the same transaction, be it a transaction of purchase of goods, services, or whatever, they were being subjected to various kind of taxes, and ultimately who was suffering or who was bearing the burden of these taxes? It was the consumer. More the taxes means more complications, more compliances mean costs, and if the taxes exceed a particular limit, it also leads to something that is called evasion of taxes, black money. And that has been a problem that has been plaguing this country, that we did have a parallel economy, we did have black money, and people, especially the small traders and all, would be enticed not to join the mainstream system because of the taxes, the compliances, and so on. So what did the government decide? That if we could make our taxation system simpler, right, and instead of having so many taxes which are scattered at various places at the central government level, state government level, and local authority level, if we can bring it under one particular statute, right, and leave it to the government as to how the government distributes these taxes between itself, between its various constituents, right? The taxpayers or the industry would be enticed to do the compliances and pay the taxes, which would ultimately mean what? Augmenting the resources of the government, and this money will be used for the purpose of development activities. This was the basic premise of GST. Let's see to what extent the government has been successful, right? And now it is really a positive step in the taxation system. In India, and generally this principle also applies all over the world, the taxes can be classified into two categories, direct and indirect. Let's try to first of all understand what is a direct tax and what is an indirect tax. Right? Direct tax means a tax which is directly levied on the person who is the beneficiary in a particular transaction. For instance, when you earn income, be it by way of salaries, be it by way of professional income, be it by way of profits when you are engaged in any kind of business, right? There's a tax which is charged on you, which is called income tax. Two main ingredients of income tax. A, the tax is directly linked to your income. It is a percentage of your income. As your income goes up, the quantum of tax also goes up. And secondly, whatever the income that you earn, that is generally paid by you directly to the government. This kind of a tax or this class of taxes is called direct tax. On the other hand, there is another type of taxes which is charged by the government, whereby though you as a consumer is obligated to make that payment, but the of taxes, but the payment is not made by you directly to the government. It is a supplier of goods, it is a supplier of services, right? Or it's a third party from whom you are availing some kind of a benefit. He is the person who collects the taxes from you and ultimately pays it to the government. Let's take an example. What happens when you buy a TV? You go to a shop, you are the consumer, you purchase the TV, right? Your the dealer or the shopkeeper or the store, wherever you go, he issues an invoice to you. In the invoice, there's a consolidated amount, and the consolidated amount is further broken up into two parts. One is the cost of the good or the selling price of the goods, and second is the tax, right? So, who's paying the tax? You are paying the tax. But are you paying it directly to the government? No. You are paying it to the dealer or the shopkeeper or the store who is selling the goods to you, who in turn, after collecting the tax from you, pays it to the central government. So this class of taxes is called indirect taxes. As you see in my cursor over here, right, under the old system, before GST was introduced, what was the class of taxes which are coming under indirect taxes? We had a service tax, a tax which was charged on the services. We had a VAT, which was basically sales tax, a tax which was charged on sale of goods, excise duty, a tax which was charged on the manufacture of goods, and custom duty, which was and which still prevails. This is charged on the import of goods into the country. Okay. This is something that I've already discussed. That excise duty was charged on manufacture, custom duty is on imports, service taxes on services, and VAT is on sales. If you see the further classification of these taxes, a part of these taxes were levied by the central government, and some taxes were levied by the state government. Right. Well, I would like to qualify my statement over here that it doesn't mean that these were the only taxes which could be classified as the indirect taxes. The various other taxes which are charged by different bodies. You have the entertainment tax, octroi and all, provision tax, which is would also generally come under the category of indirect taxes. But for the purpose of GST, we are and for the purpose of study, we are basically considering these taxes, which you can see on the screen. As far as central government taxes are concerned, what was there? You had the service tax, you had the excise duty, and you had the custom duty. And as far as state government taxes are concerned, we had the sales tax, which is popularly known as value-added tax. So what was the problem? The problem in that regime was that when it came to central government taxes, like the service tax, excise duty, and custom duty, there was a uniform application of the law or the statute instituting these taxes or levying these taxes throughout the country, which means, as far as service tax is concerned, right, the law that was applicable to Delhi was also applicable to the state of Maharashtra and was also applicable to the state of Karnataka and to Tamil Nadu on a uniform basis, right. If the rate of service tax was 15%, it was applicable to Delhi, Maharashtra, Tamil Nadu, or whatever throughout the country. The provisions of the law were also same, right. Same was the case with excise duty, and the same was the case was and is the case with custom duty. It doesn't really matter when you're importing goods whether your goods come by sea to JNPT or to Kandla or to Visakhapatnam, wherever. The rate of custom duty would depend upon the type of goods and the value of goods. But when it comes to state government taxes, it's a prerogative of the state government, right? And the respective state governments charge those taxes, and these governments are free draw within the ambit of the model law to have their own taxation laws, and to also fix the rate of tax which they would be charging, right? This created various issues. The same goods could be taxed in different states at different rate, right? So if you are in Maharashtra, you like exactly what is happening in the case of fuel, petrol, right? The government of Maharashtra would be charging tax on fuel at a different rate. Delhi would be charging at a different rate, and that is one of the prime reasons that why petrol in Delhi is cheaper than much cheaper than what it is in Maharashtra, right? And secondly, the laws would be different, which would mean that the understanding of the law or the understanding of the statute by the people who were subject to these taxes, right, also became a bit of a complication or a major complication. Third, when goods would move from one state to another state, the taxation law of both the states would become applicable, leading to a third anomaly, and this was also resulting into the restriction of movement of goods. The goods would be held up at the borders of states just to ensure certain compliances of taxation, and that meant additional cost and delay in delivery. So there was an urgent need to obviate all these problems, and to do that, the government thought that why don't we just consolidate all these taxes into one single tax, right? So that as far as the consumer or as far as the end user is concerned, he only pays that tax, and that is exactly, as I said earlier, was and is the objective of GST. So what we really need to understand over here is that GST is not a direct tax; it's an indirect tax. Right. So we take income tax totally out of it, and we'll see now, do a comparison as to how the regime changed and what is the basic concept of this indirect taxes. In order to understand the levy of GST, first of all, we need to understand the concept of value-added tax, because most of the indirect taxes are value-added taxes. I'll just read it out from here. Indirect tax on domestic consumption of goods and services, except those are regulated, are otherwise exempt. It is levied at each stage in the chain of production and distribution of raw materials to the final sale based on value of the price. Right? It is not a cost to the producer for distribution chain members. What does it mean? See, there could be a possibility that a manufacturer, he first of all sells, and this is generally what happens, his goods are of a value of 10,000 rupees, and the rate of tax is 10%. So what he does is, he sells the goods to a dealer and charges a tax of 10% on 10,000, which means the tax would be 1,000 rupees. Let me take a Excel sheet over here, and I'll just try to explain you this particular concept. Just give me a second, please. Here is a manufacturer, and his selling price a particular good is 10,000 rupees, and he charges a tax at the rate of 10%. So the tax obviously would be 1,000. And instead of selling this goods to the consumer directly, he sells the good to a dealer. So what will be the price of dealer? It will be 11,000 rupees. Now the dealer sells these goods to a distributor. Right? Again, he would be charging a tax of 10%. So what will be the tax? 1,100, and this will be the cost to the distributor. He sells the goods. Now it will be 12,100. He sells his goods to a retailer, again charging a tax of 10%. It makes it 1,210. It goes to a retailer, and the retailer. So what is his cost? 13,310. And now the retailer sells his goods to the consumer. Again, a tax is charged at the rate of 10%. So it will be 1,331. So what is the final price to the consumer? $14,641. That means if this system is followed, what happens is, and what is the flaw of this particular system, that as your number of levels increase, or the number of times the goods change hand, right, that the tax is charged, and ultimately who's bearing the brunt of this enhanced taxes, this levy of taxes at stage number 1, stage number 2, stage number 3, stage number 4, it is the consumer. This is called cascading effect of taxes. In order to obviate that, a concept was introduced in the case of indirect taxation, which is called value added tax. And here what I have done is, I have not taken any value addition. I have taken only into consideration as if 10,000 rupees goods were sold to the dealer at with a tax of 10,000, and the dealer did not take any profit over here. So it's and then he just took another 10%, which is not really going to be the case, because the dealer would also be charging, or would also be taking a profit, and there could be a possibility that he may be doing some further processing on that, maybe packaging, repackaging, or any other process that may be appropriate or that may be required for those particular goods, right? So let's try to understand what is exactly this concept of value-added tax. Under the value-added tax concept, what happens is, right, that when you sell any goods or you provide any services, right, you charge a tax on that. This is called the output tax. And on that, what you do is that when you had purchased the goods, or when you had availed any kind of input services, right, you would have paid some tax on that, right? Now this tax which was paid by you to the person or to the dealer from whom you had purchased the goods, right, would have already been deposited by this person with the government. So what is your obligation? Your obligation is only to deposit the difference between the tax that was paid on the inputs, right, and the tax which has been collected by the dealer on the output. For instance, if I go back to this particular sheet, right, instead of the dealer, here what the dealer has done, when he sold the goods to the distributor, he charged a tax of how much? 1100, right? If we go by this particular table, right, the manufacturer would deposit 1000, the dealer would deposit 1000, the distributor would deposit 1210, and the retailer would deposit 1331 if this system was being followed, which is an incorrect system. But under the value added system, when the manufacturer sold the goods to the dealer paid him 11,000 rupees, but out of this 11,000 rupees, 10,000 was the cost of the goods and 1,000 was the tax, which the manufacturer would have deposited with the government. Right? Now, when he sells the goods to the distributor, right, he gets 12,100, out of which, as far as 11,000 is concerned, that is his cost, and 1,100 is what that is the tax that he has collected, right? So what he does is that instead of paying this amount of 1,100, he takes a credit of this 1,000, right, and he only deposits 100. So this is the concept of value addition. Let me just explain you with another example over here, which will be a more appropriate example. Suppose there's a shop AS which is registered in VAT, right? And he purchases the goods for 49,600 excluding VAT, and the rate of VAT is 25%. So what is the VAT he would have paid on 49,600? He would have paid a VAT of 12,400. During the same period, what he does, the goods which he had purchased for 49,600, he sells it for 1,50,000, right? And the rate of the VAT remains the same, which is 25%. That means on the sale that he did, he charged a VAT of 37,500. Right? Sorry. He charged a VAT of 37,500. Right? So how does he discharge his tax liability? What he does, that this dealer on the output value, which was 1,50,000, he charged a tax of 25%, which is 37,500. This money has come to him. Now, out of that, what he does, that on the value of the goods or on the cost of the good that was purchased by him, which were ultimately sold. Now, here there's a value addition. What is the value addition? 1,50,000 minus 49,600, whatever be the amount, right? On this 49,600, he has charged 25%. That was 12,500. So what is the tax he is paying? He is paying a tax of 37,500 minus 12,500 to 25,400. If you do a calculation, you'll see this 25,500 is 25% of the difference between 1,50,000 and 49,600, which means that at every stage, whatever be the value addition, the tax is paid only on the value that is added, right, at different stages. So ultimately, when it comes to the consumer, he doesn't have to pay taxes by way of cascading effect, as we saw in the first example. Rather, what he is doing is that every person has paid tax on the relevant value that is added at his level, so that ultimately the consumer pays the relevant amount of tax on the cost of the goods that is borne by him. Right? So this was the whole concept of value-added tax which was working in our country, and this is a practice which is also prevalent in various countries. So what was the problem? And in the earlier regime, one of the problem was that though we were working under the concept of value-added tax, and the basic objective of the value-added tax was that there is no cascading effect, but it was not totally eradicated because different taxes being charged by different bodies, right, which were resulting into tax upon tax, right. For instance, there was a tax called excise duty, which was being charged on the cost of the goods, right, on the manufacturing price of the goods. For instance, in case of excise, suppose there's a manufacturer, his sale price is say 10,000. He charges an excise duty on this, say 10%, 1,000. So this becomes 11,000. Now, the sales tax, suppose that is also 10%, that was being charged on 11,000 because this was the central government tax and this was the state government tax, right? So it would become 1,100 and the final cost would be 12,100. Is it not a case of tax on a tax? Because to the extent of this 100 rupees, which has got added to the value of the goods, it is a tax on this excise duty. And this anomaly was there, or this process was there, primarily because this tax was being charged by the central government and this tax was being charged by the state government. Now, if we subsume these two taxes, subsume means that if we consolidated these two taxes into one tax, which is the objective of GST, what would happen? Only one tax would be charged on the basic value of the goods. And that was the reason why GST was introduced. Right? So both excise duty and sales tax is charged on the same goods. Excise duty is charged by the central government and the VAT sales tax is charged by the state government. State government does not receive credit of the excise duty paid on the manufacturer of goods by the manufacturer to the dealer of goods. VAT is also charged on excise duty component, including the price of the goods. That is something that I've already explained to you. So this was a major shortcoming. Secondly, you see, how does the system of VAT tax works? It works on the basis that from the output taxes, you would be taking a credit of the input taxes. It was not really possible to get the 100% credit of the input taxes. Let's take an example. I am a service provider, right? In that regime, what I would do, I raised an invoice of 1 lakh rupees. The service tax was say 15%, right? So I would be charging a tax of 15,000 on my invoice value from my customer, and 15,000 is my obligation that I needed to pay to the government. Now, to provide these services, assuming that I purchased some goods, which got consumed in the process of providing these services. Now, on this good, what I did, I did not pay any service tax because service tax was applicable only on services, as I explained to you earlier. Or rather, what I did, I paid VAT to the dealer from whom I purchased these goods. And suppose the quantum of this VAT was say 5,000 rupees, whatever be the rate. Since service tax was a central government tax and VAT is a state government tax, so as a service provider, I was not able to take the credit of this VAT against the service tax that I had collected. That means what would have used to happen in that case was that 15,000 had to be deposited with the government, right, by way of service tax, and 5,000 rupees which I had paid on the purchase of goods would also be deposited by the dealer from whom I had purchased the goods. So in effect, my total tax on this transaction was 15,000 rupees plus 5,000 rupees, which is 20,000. I hope you have a clarity on this. But if both the input tax and the output tax come under the same category of tax, say GST, and assuming and that the rate of GST is 15%, which is not the case now, it is 18%, but assuming just to bring parity to the example, so I would have charged GST of 15,000 rupees on my invoice of 1 lakh rupees, right? On my input, it doesn't really now matter whether it is goods or services, because it's an input tax and it's the same category of tax, right? So I would now I am able to get a credit of this 5,000 rupees, right, against the output tax of 15,000 rupees, and I would be paying a net of 10,000 rupees to the government. So I hope you realize that under the current system, what is happening is, because the output tax is also a GST and the input tax is also the GST, right? So another anomaly which was happening in the earlier regime, that the trade or the service providers or the manufacturer or the supplier of goods were not able to get a full credit, 100% credit of the input taxes, right, the cost would go up, and who would ultimately bear the brunt of that cost? It will be the consumer. Now, why this is called goods and service tax? Let's try to understand that. What the government did, it consolidated certain taxes, right? Both the central government taxes and the state government taxes, and the term that we use is called subsumed. Now, what were the taxes which were subsumed? Central excise duty, duties of excise, medicinal and toilet preparations, additional excise duty, additional duty of excise on textiles and all that, additional custom duty, special custom duty, central charge, central cesses. These are generally all the taxes which are charged on goods. As far as state government is concerned, right, you have the state VAT, entertainment tax, central government tax, entry tax, purchase tax, luxury tax, lottery tax, betting and gambling tax, right, and other state taxes and all that. And one more tax that got subsumed was the service tax, right. So if you see this tax, this tax, this tax, and this tax, this is a tax on goods. Additional custom duty, special custom duty, this is again a tax on goods. But service tax was not a tax on goods, it was a tax on services. And as far as these taxes are concerned, right, this was again something like a service tax only, as when you pay entertainment tax, it's a service tax, right? Then you have the state VAT, which was again a tax on goods. When all these taxes got subsumed and they got consolidated into one particular tax, it became a tax which was charged on what? It was charged both on goods as well as services. So that is why it came to be known as goods and service tax. So just a quick review as to what are the advantages of GST. The advantages of GST can be summarized as follows. There will be no cascading effect of taxes. Credit of GST paid on input services and capital goods, barring certain negative lists, will be available to the SSE. This will bring reduction in the cost of goods. I've already explained you this. Tax collection will be much easier, as on the same transaction only one tax would be charged. There will be no plethora of taxes, right? Less the number of taxes, less the number of transactions, less will be the compliance, and less will be the cost, right? Paperwork and compliance cost and time will substantially decrease. In order to bring this regime of GST into place, right, certain statutes were enacted, which are in place now. Right. The main statute that was enacted was Central Goods and Service Tax, which is called CGST, right, which is applicable on what? It is applicable on intrastate supply of goods and services. Intrastate means within the same state, right? Both the supplier of goods and the services of goods or services, because this is a GST, which is a tax which is applicable both on goods and services, right? If both the parties are located in the same state and the transaction happen in the same state, what is the tax that will be applicable? It is going to be central government, central goods and service tax, right? And the act which was enacted to facilitate the levy of this particular tax was called the Central Goods and Service Tax Act, right? Another tax that is levied on the intra state supply of goods and services, that is called State Goods and Service Tax, SGST, which will be levied on all intrastate supply of goods and services, right? So that means on intrastate supply of goods and services, GST would be levied with two components. What is what? One is CGST, which is the Central Goods and Service Tax, and the second is SGST, which is the State Goods and Service Tax, right? So that means, see, when we say that the rate of GST is 18%, which is most of the goods and services come within the levy of 18%, 9% of that is CGST and 9% of that is SGST. But the situation changes when the goods are the movement of the goods or the supply of services is between two states. That means the supplier of goods or services is based in one place, and the person who's purchasing the goods or who's availing the services is based in another state. For instance, I am a supplier of a particular service. Maybe I'm providing some consultancy services. I am based in Maharashtra, and I'm providing these services to someone who's based in Gujarat. Right. Now, this cannot be taken as a part of intrastate supply because the supplier and the beneficiary are based in two different states. So this is called interstate supply of goods and services. When it is a case of interstate supply of goods or services, right? Please note, it is not CGST which will be applicable. It is not SGST which is applicable. There's a third type of tax which is applicable, which is called Integrated Goods and Service Tax, which in the abbreviated form we call it IGST. Right, and for that a separate act was enacted, which is called the Integrated Goods and Service Tax Act. Right. Similarly, for union territories, right, GST will be levied where the transaction is in intra-union territories. It means where the location of the supplier and the place of supplier is in union territory. That is called UT GST. So I hope you have been able to understand the levy of GST. Let's go further. Right. There are certain commodities which have been kept out of the ambit of GST. Alcoholic liquor for human consumption has been kept outside the purview of GST, which means that the state government taxes would still be levied, right? And there are 5 petroleum products which, for the time being, have been kept outside the purview of GST: petroleum crude, motor spirit, high-speed diesel, and natural gas, and air turbine fuel. They would still be subject to the existing regime of taxes, which is the VAT and the excise. Now, I think it is, as we're reading in the media reports, that there could be a possibility that in the near future, and there's a demand also which is coming, that all these petroleum products should also be brought within the ambit of GST. And when they are brought within the ambit of GST, because there would be a uniform levy of GST in all over the country, so generally the rate of fuel all over the country would be the same, right? And this disparity, that the rate of fuel in one particular state is much higher than the rate of fuel in another state, would be taken care of. So this is basically a repetition that intrastate CGST and SGST would be charged, and as far as the IGST is concerned, IGST would be charged on the interstate supply of goods. Right. Now let us see what is a taxable event. What do you mean by the term taxable event? What is it that triggers off the tax, right? As far as income tax is concerned, what triggers off the tax? It is the point of time when you earn an income. Suppose somebody gives you a loan, it's not your income, so you don't pay any tax on that. It is only when you earn an income, then only you pay taxes. Similarly, in case of earlier, as far as VAT was concerned, right? What was the point of time, or what was the taxable event when you were liable to make the payment of taxes? When you purchase the goods. And what do you mean by purchase of the goods? That the ownership of the goods changes from the seller to the buyer. And that was a time when you were obligated to make the payment of the tax, irrespective of the fact whether you paid for the goods or not. Same was the case of services. When you avail the services, right, that was a time which we used to call provision of services. That means when the services have been provided, that was the point of time when service tax became applicable, right? In case of GST, the taxable event is the supply of goods and services. That is what we need to understand, right? And then we have to get into a definition of supply as to what actually supply is all about. So it is not the sale of goods, it is not the provision of services. What we say is the supply of goods and services. Supply includes all forms of supply of goods and services such as sale, transfer, barter, exchange, license, lease, or disposal made or agreed to be made for a consideration by a person in the course of furtherance of some business. The key word over here is that whatever the transfer has been made or whatever the supply has been made, it has to be in the course of furtherance of some business, right? That means it has to be basically for the purpose of trade transactions. Import of services for a consideration whether or not in the course of furtherance of business, the activities to be treated for goods and supply of services are referred to in Schedule 2. There are different schedules are there which basically provide that what are the goods that would be, the three schedules are there, that what are the circumstances in certain goods and services would be treated as supply and what are the circumstances they will not really be treated as supply. As of now, we will not get into details of that. That we will study in the forthcoming sessions. Right. So this is basically an introduction to the topic to GST, which is goods and service tax, right? And the whole objective of this particular session was to explain the participants as to what is the value-added tax, right? And where was the necessity to do away with the existing system of taxation and to bring in a new system of taxation. Right, and what was the objective? So basically, the objective was to make the system of taxation as simple as possible, right? To avoid the cascading effect of taxes, to enable the value-added tax system to work in a very efficient manner, so that a credit can be given for all the input taxes against the output taxes, right? And in the end, what we discussed was that, or what we understood was that the taxable event in case of GST is the supply of goods and services, right? And notwithstanding the fact that GST is levied on two types of transactions. One is an intra-state transaction, which is which is the supply of goods or services within the same state, when the seller and the buyer, right, or the service provider, the provider of service and the beneficiary of the service, they are in the same state. Then in that case, two taxes are charged. One is CGST and the second is SGST. Right. And as far as the intrastate supply of goods or services is concerned, that means when the goods or services are transferred from one state to another state, it is neither the CGST nor the SGST, it is the IGST which is charged. Right. I hope with this everybody has a very basic understanding of what GST is all about. Right. In the next sessions, we will get into the details of various provisions of the GST Act, right? And what is the procedure and what are the processes that need to be followed and what are the different kind of compliances that need to be done for the purpose of GST. With this, allow me to close the session. I hope all of you got a value in what we discussed today. Thank you so much.